This week we're going to lecture on Chapter 10, which we're going to focus on reporting and analyzing specific liabilities. In particular, we're going to focus on the liabilities that we've already seen, like notes payable, unearned revenue, but we're going to also look at some new liabilities like sales tax payable and bonds payable. So of course, notes payable we've seen before. It's when we take out a loan, we write a promissory note, signing loan documents where we require the issuer to provide us with details about the specifics of the loan, how much principal we've taken, that's the total amount of the loan, how much interest we'll be paying, as well as when we're required to pay that loan back. Remember, current liabilities are things that are usually due within a year or less. If the note is for a promise to pay back in greater than a year, that would be a long-term liability and would be handled in a different section of our balance sheet. So the focus here is on the current liabilities and the short-term note payable. So for example, if we were to borrow $100,000 in September, we would sign a promissory note for 12% interest for this 4-month note. And so when we actually receive the liability, where we've received the payment from, or the proceeds from the loan, we're going to increase our cash account for the value of the loan that we've received, at the same time recognizing that we now have a notes payable for the face value of that loan. Once we issue or sign documentations for the loan, then we're going to record just the value of our assets increasing as well as the liability increasing. It'll be later that we record the interest on those individual liabilities. So when we prepare our financial statements, we would adjust for the fact that we had some interest expense that we incurred for that particular loan. That same loan, if we go back, was $100,000, 12% interest for a 4-month period, so a short-term loan. So the interest of $100,000 times the 12%, and only 4 out of 12 months, so fractional time period here, is $4,000 total interest that we've incurred for taking out that short-term loan. So we're going to incur the interest expense at the same time as incur the interest payable. Now the interest payable will come into factor when we actually pay the loan off, but we want to make sure that we incur and show the expense for our income statement at the time that we incurred the expense. So when that loan matures and we actually pay off the note, we also pay the face value of what we borrowed, the $100,000, plus the interest that we had to pay for that loan. So that will be the total value of the note payable, closing out the liability account, closing out the interest for the payable for the interest, the $4,000. So the total payment that we're making is $104,000 for taking out that small loan, or short period loan, not necessarily a small loan, but a short period loan. Another example of a current liability would be sales tax payable. Sales tax payable is something that is a percentage of our total sales. Usually when we are providing goods to customers, as long as these customers are the end users of the product, it is our responsibility to collect the sales tax from them. That sales tax is not revenue to our business, but instead it is a liability to our business because it's our responsibility to take that amount that we collected and pay to the governmental agencies that we're responsible for. So we might be paying to the state or a federal government in reference to the amount of tax that we assessed on our customers.